Let's look at accounts payable and take another look at your current assets section of your balance sheet, accounts payable and income taxes payable. So accounts payable increased $16,000. For current liabilities, increases are added back to net income. What does that mean? Let's assume the company paid for utilities expense, or rather it recognized utilities expense. They got their bill, it was $16,000, big building. They debited utilities expense and they credited accounts payable. But they haven't paid for it yet. So when accounts payable goes up, it means they received more items, expenses, whatever, than it actually paid for. So we're going to take that $16,000 and we're going to add it back. On the other hand, income taxes payable went from $8,000 to $6,000, which means the company owed $8,000 in income tax, but they paid down $2,000 of it. So we're going to subtract that. So take a look now. You see accounts payable, that net change being added back. Accounts payable, income taxes payable being subtracted. So we come down to net cash provided by operations of $172,000. Please take a minute and make sure you logged all of these items in there under the cash flow from operations. And I realize it's a little bit, there's not quite enough room, but just kind of squeeze them in there. And what I like to do is I like to just use a delta sign and I say change AR, change inventory, change prepaid, change accounts payable, and change IT payable. And then just log those numbers in. 10,000, 5,000, 4,000, 16,000, and 2,000. And that'll really be helpful for you as you start doing homework problems. You'll show that the net cash provided by operations is $172,000. Now, really common mistakes that students make at this point is they forget to include the $145 in this total. So you may want to make sure you include all of these items. And then sometimes students, instead of using the net change, they actually use the current year ending balance. And please don't do that. That's not a good thing. You want to use the net change. So cash from operations is probably the most complicated piece of the cash flow. So let's go on to step 3, cash flow from investing and then financing. So what do we look at with investing? We look at long-term assets, and you can see them on your balance sheet. These are non-current or long-term assets. You can describe them either way. So these are your land, your building, and your equipment, and their associated accumulated depreciation. So let's start with land. Remember, land is $110,000 was purchased through the issuance of long-term bonds. Now we're dealing with this additional information here, as well as what we can see on the balance sheet. You can see that land went up $110,000. If you look down at bonds payable, you can see that bonds payable also increased $110,000, and this is consistent. So this is going to be a non-cash transaction. So it's going to be at the bottom of your cash flow report. So just write it in there. Purchase land by issuing bonds. You know, something simple but clear, $110,000. And you are not going to record that $110,000 anywhere on the other above sections. It's in its own section on the cash flow report. Let's go on to buildings. An office building was acquired using cash of $120,000. This is a cash outflow. So let's make sure that we include it as a negative. And we also, in our notes, if you look at your additional information, we see that equipment costing $25,000 was also purchased for cash. Now what I would do at this point is I would make a little note, make a T account for that equipment. I would make it at the bottom of my page, and you can see that right there. So and let me just show you that really quick. So we have equipment, the equipment account. You can see on your balance sheet that you had a beginning balance of $10,000. You can see on your balance sheet, here's your 10,000. You have an ending balance of 27,000. And I would write this down. I would copy this down on your additional information. We know from the additional information that we purchased 25,000 of additional equipment. We would have debited equipment. This is the T account for equipment for 25, but that's not going to add up. 10 plus 25 does not equal 27. But we also know from the additional information, item 4, that we sold equipment. Now, what you see here is the original cost, because remember, when we sell, we take the original cost out of the asset account. We account for the cash proceeds, we back out the accumulated depreciation, and then we recognize a gain or loss. So for the purposes of investing, you are going to want to record the actual purchases of 25,000. So you will record the building as a cash outflow, and you will record the purchase of equipment, the whole 25,000. Now here's where we use some additional information as well. That 4,000, the money we got from selling long-term assets, we report in the investing section of the cash flow report, and here it is. And it increased. It was a cash inflow of 4,000. So we have 3 items here. So go ahead and write those down on your worksheet on page 7. Your purchase of building, your purchase of equipment, and your sale of equipment. And you're going to show those again as indented. And sometimes students see that negative there and they'll say, oh, they had a loss in equipment. There are no gains and losses on the cash flow report. It is meaningless to say they had a loss, when in fact spending money on equipment and buildings often is a really good sign that the company is healthy. So you want to say they invested $141,000. They had a net investment of $141,000. All right, moving down the balance sheet. We have accounted for land, we've accounted for building and equipment, and we just kind of note the accumulated depreciation, but we don't account for them on the cash flow. You can see that if you took the time to say the $6,000 decrease in accumulated depreciation building, and $2,000 decrease in equipment, if you added those together, you'd come up to $8,000. But remember, we retired that one piece of equipment and we wrote off its $1,000 of accumulated depreciation. But if we were to add that back, that would add up to $9,000, and that would tie out to the depreciation expense on your income statement. But we don't have to list it on the cash flow report. Okay, so we are done with the assets. We've accounted for all of them. We are done with the current liabilities. Now we're going to the long-term liabilities. And long-term liabilities and stockholders' equity will be reported in the financing section of the cash flow report. So as a reminder, bonds payable went up $110,000. We've already accounted for that. It's listed in the footnote at the bottom of the cash flow report, so we don't need to use it a second time. We now have common stock increased $20,000 and retained earnings increased $116,000. Now let's look at your additional information. We still have the first item, which is under financing. We're going to need to list that in this section. Item number 2 we've already worked with. Item number 3 we've already worked with, and 4 and 6. So that leaves number 1 and number 5. The company issued stock for $20,000 cash. So we're going to put that on the cash flow report under the financing section. Is this a cash inflow or is this a cash outflow? Now if you were in my class at this point, I'd say thumbs up for inflow, thumbs down for outflow. So this is going to be a thumbs up. Okay, so we're going to add that to the cash flow, and you can write that in on your worksheet right now. Issued stock. Let's do that real quick, and that'll be plus 20,000. Now we know that retained earnings increased by 116,000. However, let's balance that out. Retained earnings is increased by 116,000. Let's make a little T account. We've got retained earnings beginning balance, and that is 48,000. We'll show that on the credit side. leave some space, and then say retained earnings ending balance 164,000. Now we know that net income increased retained earnings, that would be on the credit side. And we know from our additional information that dividends of 29,000 were were declared and paid. Dividends would go on the debit side of retained earnings. And that just is a way to sort of balance and make sure that you accounted for everything. And if you take 48,000 beginning balance plus 145,000 minus 29,000, that will equal your ending balance of 164,000. So we've accounted for the $145,000 of net income. We listed that as the first line in the statement of cash flows under operations. But now we've got to list the 29,000, and that will go under what? Cash flow from financing, cash inflow or cash outflow, thumbs up or thumbs down. That'll be thumbs down, it's an outflow. So here we have the final cash flow report, and you can see these sections here. We've got the beginning balance of, the net income, the 172,000. You've got cash from investing outflow, 141,000. And here in the financing section, you have 20,000 coming in from common stock, 29,000 going out, net cash used by financing, an outflow of 9,000. So again, if we add the 172 minus the 141 minus the 9,000, you will get to your net increase in cash. You knew that. You knew that at the beginning of the problem. It's always good when it actually balances. And so a last piece to the cash flow report is to list cash at the beginning of the period, which is 33,000, and cash at the end of the period, which is 55,000. So that ends part 3. You now have a worksheet you can use for your homework problems, and that will help you going forward.